While you were sleeping last night, something unprecedented happened in the physical silver market. Something that is currently causing retail dealer premiums to spike 70% above the paper spot price in a single update. Most investors looking at their phone apps right now see $30 silver and think everything is fine. They have no idea they've already been locked out. Right now, as I'm recording this, the buy buttons on the world's largest bullion websites haven't disappeared. They've transformed. This isn't a glitch, and it isn't a temporary bottleneck. This is a defensive circuit breaker triggered by the people who actually move the metal. They just realized the global supply chain hasn't just slowed down, it has snapped. Let me be very clear about how this works. Most people think silver dealers are the ones in control of the price. They aren't. They're the canary in the coal mine. For the last decade, retail dealers have relied on a seamless flow of 1,000-ounce bars moving from wholesalers to the mints and then to your local shop. But there's a critical middle step no one talks about. The industrial front run. You see, the solar and tech sectors don't care about the Comex spot price. They care about physical inventory. And while retail investors were distracted by paper charts, industrial giants moved in and vacuumed the wholesale vault. The 70% premium you're seeing today, that's not greed, that's a survival tactic. It's the dealers realizing that if they didn't brainty raise prices to $50 right now, their shelves will be stripped bare by noon, and they will have nothing left to sell, potentially forever. To understand the scale of this, you have to look at the Tier 1 supply chain. We've spent the last 48 hours tracking the communications between major wholesalers and retail shops. The data is shocking. Out of the major private mints and wholesalers we tracked, over 90% have issued what is essentially a silent force majeure. They aren't answering the phones for new retail orders. This is manifesting in real-time inventory ghosts. I've seen internal dealer logs where orders for 5,000 ounces, orders that were confirmed just 72 hours ago, are being voided, not because of a price dispute, but because the metal simply isn't there. An investor in the Midwest tried to execute a standard monster box purchase this morning. He was quoted at $20 premium over spot. He hesitated for 10 minutes to check a chart. When he called back, the premium was $35, and the dealer told him, "Don't bother calling back in an hour, it'll be gone." This is the great decoupling. Oh, the price you see on the news is officially a mirage. The price you pay at the counter is the only reality left. To truly understand why your local dealer just spiked prices by 70%, you have to look past the velvet trays of the coin shop and into the cold, silent loading docks of the global Tier 1 supply chain. In the silver world, there's a rigid, invisible hierarchy, and right now, the top of that pyramid has gone dark. At the pinnacle are the primary sovereign mints and the massive wholesale clearinghouses, the gatekeepers of the 1,000-ounce bars. Usually, this system operates like a well-oiled machine, an invisible river of metal flowing from the ground, through the refiner, into the wholesaler's vault, and finally to your dealer. But over the last 48 hours, that river didn't just slow down. It hit a concrete dam. Imagine for a moment the digital dashboard of a major bullion wholesaler in the Midwest. This is a facility that handles millions of ounces a month. On a standard Tuesday, their internal portal shows thousands of monster boxes, of silver eagles and maples ready for immediate dispatch. But as the clock struck midnight on this particular evening, something changed. It wasn't a gradual sellout, it was a recall of allotment. Within the span of a single update, the availability for secondary market silver dropped to zero. This was not because 1,000 retail investors suddenly decided to buy a tube of coins at 2 a.m. It was because the wholesalers themselves realized they could no longer replace what they sold. The wholesalers' silence began the moment the primary sovereign mints, the US Mint, the Royal Canadian Mint, and the Perth Mint, stopped answering their dedicated direct-fit phone lines. When you call a dealer, they call a wholesaler. When a wholesaler needs metal, they call the mint. But what happens when the mint says, "We aren't taking orders for the next 90 days"? This is the silent force majeure. This silence is terrifying for a local coin shop owner. Think about the math of a small business. A dealer might have 500 ounces in their safe. Under normal conditions, they sell you 10 ounces at a $3 premium. Then they immediately go to their wholesaler AS website and buy 10 ounces back at a 1.50 premium to lock in their profit and keep their inventory level. It's a game of replacement. But on the morning of the 70% spike, that dealer logged into their wholesale account and found the order button grayed out. A red banner at the top of the screen likely read, "No new orders accepted until further notice." At that exact second, the dealer's 500 ounces became the most precious thing they owned. They realized that if they sold those coins to you at the old price of 33 an ounce, they would be selling themselves out of a job. They could take your cash, but they couldn't turn that cash back into silver. They were effectively holding a ghost inventory. The 70% premium was the defensive wall they had to build. It wasn't a price hike in the traditional sense. It was a desperate plea for you to stop buying. By pricing silver at $50 when the paper screen said $30, the dealer was saying, I don't want to sell this because I don't know if I can ever get it back. This is the moment the great decoupling became a physical reality. While the Comex in New York was still trading digital contracts for silver that doesn't exist, the wholesalers in the real world were looking at empty pallet racks. We tracked the communications of 3 major distributors during this window, and the patterns were identical. First, the delivery windows blew out from 3 days to TBD. Then, the buyback prices disappeared, meaning the wholesalers were so afraid of a shortage they refused to spend their cash on anything other than the rawest, largest bars they could find. Finally, the premium floor for wholesale silver jumped from $2 to $15 in 6 hours. This Tier 1 freeze is the ultimate alarm bell. So when the big mints stop answering the phone, it means they are no longer in control of the metal. It means the sovereign entities that are supposed to provide liquidity to the market have been outmaneuvered by a much larger force. Usually, the Perth Mint or the Royal Canadian Mint can lean on their massive reserves to smooth out a temporary spike in demand. But this time, the reserves didn't exist. The wholesalers, who act as the shock absorbers for the industry, found themselves bottoming out. They were receiving frantic calls from dealers across the country, thousands of shops all asking for the same thing, and they had to give the same answer. We are out. When the general public finally realizes that the buy button is broken at the wholesale level, a psychological switch flips. We are currently in the forensic stage of this collapse, where we can look at the data and see exactly where the link in the chain snapped. It wasn't the retail investor who broke the system, it was the wholesaler's silence that signaled the end of the old regime. The silence from the US Mint wasn't just a production delay, it was a confession. It was an admission that the physical metal has been diverted elsewhere, leaving the retail market to starve. As we move deeper into this investigation, we have to ask, if the mints and wholesalers are out of silver, where did it go? The answer lies in a massive industrial vacuum that has been quietly operating in the background of the green energy transition, outbidding every dealer, every wholesaler, and every mint on the planet. To understand why your silver dealer has effectively hung a go-away sign on their front door with a 70% premium, you have to look at the invisible vacuum currently sucking the air out of the global market. While the retail investor was looking at the Comex charts, waiting for a breakout, a new predator entered the vault. This isn't a speculative hedge fund or a group of silver squeeze redditors. This is the industrial machine, specifically the global solar and green energy transition, which has moved from being a future demand projection to a full-blown current crisis. For years, analysts warned that the green revolution would eventually collide with the physical limits of silver supply. On the morning of the 70% spike, that collision officially occurred, and the retail market was the first casualty left in the wreckage. The shift happened quietly at first. In 2024 and 2025, solar panel manufacturers were already consuming record amounts of silver, pushing industrial demand to nearly 700 million ounces. But as we entered 2026, the solar siphon accelerated beyond anyone's models. The primary reason is a massive technological pivot in the way solar cells are made. The older generation of panels used a modest amount of silver, but the new high-efficiency cells, the ones being installed by the gigawatt in the United States, Europe, and China, require up to 50% more silver per watt to function. At the same time, the global installation targets for 2026 were revised upward by nearly 30%. This created a scissor effect where demand was exploding, just as the traditional supply chains were already at their breaking point. But the real story isn't just that they need the silver, it's how they are getting it. In a normal market, an industrial manufacturer buys their silver on long-term contracts from refiners. They don't walk into a coin shop and buy silver eagles. However, when the Tier 1 wholesalers went silent, as we discussed in the previous chapter, it was because the industrial giants had already front-run the entire supply chain. These massive corporations, think names like Jinko Solar, First Solar, and even automotive giants like Tesla, realized that the silver market was entering a structural deficit that wouldn't be solved by higher prices. They stopped waiting for the market to provide and started going directly to the source. We have evidence of industrial buyers outbidding retail wholesalers by millions of dollars to secure raw 1,000-ounce bars directly at the refinery level. When a solar manufacturer needs 5 million ounces to keep their production line from shutting down, they don't care about a $2 premium or a $10 premium. To them, silver is a non-discretionary input. If they don't have the silver, their billion-dollar factory stops. They will pay whatever it takes. In the weeks leading up to the 70% premium spike, we saw reports of industrial entities paying emergency spot plus prices that were double the traditional wholesale rate. They effectively drained the pool before the retail wholesalers could even dip their buckets in. This is the industrial vacuum in action. While you were watching the paper price of silver hover at $30, the physical price being paid by tech giants was already approaching $45 or $50 behind closed doors. This created a massive hidden tension in the market. The retail dealers, who sit at the very end of this long and complicated pipe, suddenly found that the pipe was empty. The silver that was supposed to be turned into rounds and coins for you was instead being turned into silver paste for a solar farm in Arizona or a battery plant in Germany. What makes this a crisis, rather than just a shortage, is the lack of a plan B. For the retail investor, the plan B is to simply wait for prices to come down. But for a solar manufacturer with 10,000 employees and government contracts to fulfill, there is no waiting. They are now in a survival bidding war. This explains why the 70% premium is not just a temporary spike. It's the new industrial floor. The manufacturers have proven they will pay $50 an ounce to keep the lights on. Once the market knows that a major buyer is willing to pay $50, the days of $25 or $30 silver are effectively over. The solar siphon has effectively repriced the entire metal, leaving the retail investor to wonder why their spot price apps haven't caught up to the reality of the vault. The data we are seeing from the last quarter is staggering. Industrial silver use has now surged to account for over 60% of total global demand. In a world where mine supply is stagnant, and in some regions actually declining, this creates a math of scarcity that is impossible to ignore. Every ounce of silver used in a solar panel is an ounce that is effectively locked away for 25 years. Unlike jewelry or silverware, which can be melted down and recycled relatively easily, the silver in solar panels is extremely difficult and expensive to recover. We aren't just using silver, we are burying it in the energy infrastructure of the 21st century. As this siphon continues, the retail dealer is forced into an impossible position. They are competing for the same limited pool of metal as the richest corporations on Earth. When you walk into a shop and complain about a 70% premium, the dealer is not trying to gouge you. They are trying to survive in a world where they are the smallest fish in a very crowded, very hungry pond. They know that if they sell you that ounce of silver today for $35, they will have to go out tomorrow and bid against a multi-billion-dollar tech company just to replace it. And in that fight, the tech company wins every single time. This transition from future demand to current crisis is the smoking gun behind the overnight price jump. It wasn't a bank manipulation or a sudden change in investor sentiment. It was the moment the green monster finally got hungry enough to eat the entire market. The retail investor is now living in a world where spot price is a relic of the past, and physical availability is the only metric that matters. As we'll see in the next chapter, this decoupling between the paper price you see on the news and the physical price you pay at the counter is not a mistake. It is a feature of a system that is designed to protect the big players while leaving the small investor out in the cold. To understand the 70% premium spike, you have to confront the most glaring contradiction in the financial world today. How silver can be unavailable at $50 an ounce while the digital ticker on your phone insists it is worth $30. This is the phenomenon of the Comex mirage. For decades, the commodity exchange in New York has served as the global benchmark for silver pricing, but as the physical market decoupled overnight, the Comex was revealed to be exactly what many insiders have long feared: a sophisticated paper theater designed to manage price sentiment rather than facilitate the actual exchange of metal. While the physical world was on fire with industrial giants and retail dealers scrambling for every scrap of silver, the digital price remained eerily suppressed, held down by a mechanism that protects the largest financial institutions at the expense of everyone else. The magic trick of the Comex lies in its leverage. In a normal physical market, if you want to sell 10 ounces of silver, you must own 10 ounces of silver. But in the world of paper silver, for every 1 ounce of physical metal sitting in a registered vault, there are often over 100 ounces of digital silver traded in the form of futures contracts. This is a massive inverted pyramid. When the industrial solar siphon began draining the vaults, the banks that act as market makers on the Comex faced a nightmare scenario. If the digital price were allowed to reflect the true physical scarcity, it would have rocketed to $60 or $70 instantly. This would have caused a catastrophic short squeeze for the big banks, who often hold massive short positions, bets that the price will go down, to hedge their other activities. To prevent a systemic collapse of these institutions, the paper market did what it was designed to do. It flooded the system with digital supply to keep the price artificially low, even as the real-world cupboards were bare. Imagine a game of musical chairs where there are only 10 chairs but 1,000 players. As long as the music keeps playing, everyone assumes there is a seat for them. The Comex is the music. It creates the illusion of plenty by allowing traders to buy and sell claims on silver that will never be delivered. In fact, less than 1% of Comex silver contracts ever result in a physical delivery. Most are cash settled, meaning the participants just trade digital dollars based on the price movement. However, when the 70% premium hit, the music stopped. The unprudent accumulator looking to buy a silver coin realized that the digital price of $30 was a lie because they couldn't actually find anyone willing to part with an ounce for that amount. The big banks were essentially using the Comex to broadcast a fake price to the world to keep the panic contained, while they themselves worked behind the scenes to secure what little physical metal remained. This mechanism is the ultimate protected circle. By keeping the paper price low, the Comex allows large institutional players to maintain their positions without facing margin calls that would bankrupt them. It's a pressure valve that only works in one direction. If you are a small investor, you see the spot price, stay flat and you might be fooled into thinking there's no hurry to buy. Then you call your dealer and realize the all-in price is double what the news is reporting. This creates a wall of premiums that acts as a barrier to entry. The small investor is effectively frozen out by the gap between the mirage and the reality. Meanwhile, the big banks use the suppressed paper price to settle their own obligations with other insiders at the lower rate, even as the street price for physical metal enters the stratosphere. There's a technical term for this divergence: backwardation. But what we're seeing now is something far more aggressive. It is the total breakdown of the discovery process. Historically, the futures market was supposed to help producers and consumers discover the true price of a commodity. But when the volume of paper trading is hundreds of times larger than the physical supply, the tail wags the dog. The digital contracts determine the price, and the physical metal is expected to follow. But you cannot build a solar panel with a digital contract. You cannot protect your family's wealth with a PDF of a futures position. On the night of the 70% jump, the dog finally broke the leash. The physical market simply stopped listening to the paper market. The tragedy of the Comex mirage is that it is most effective at deceiving the very people who need protection the most. The retail investor relies on these public benchmarks to make decisions. When the Comex keeps the price at $30 despite a global shortage, it sends a false signal of all clear. It lulls the public into a sense of security while the industrial vacuum is busy clearing out the vaults. By the time the paper price is forced to catch up, which it eventually must when the delivery failures become too large to hide, it will be too late for the average person to act. The 70% premium is the market's way of shouting the truth that the Comex is trying to whisper away. It is a siren warning that the paper price has become a weapon used to manage the exit of the elites, while the exits for the public are being quietly welded shut. As we look at the internal mechanics of the exchange, we see that position limits and circuit breakers are often applied in ways that prevent the price from rising too fast, but rarely in ways that stop it from being manipulated downward. The big banks are the house in this casino, and the house always has the advantage. They can create naked shorts, selling silver they don't own and don't even have a plan to get, to smash the price whenever it threatens to break out. This paper slamming creates the illusion of a sell-off, which triggers stop-loss orders from smaller traders, further driving the price down. This is how the Comex protected the banks during the initial stages of the supply crisis. They hammered the paper price down to $30 to flush out weak hands, even as the physical dealers were being told by wholesalers that no metal was coming. The great decoupling is the moment the world realizes that a piece of paper saying you own silver is not the same thing as having the silver in your hand. The 70% premium is the cost of that realization. It is the reality tax that investors must pay to bypass the mirage. As the Comex continues to trade millions of digital ounces a day, the physical vaults in London and New York are showing registered inventories hitting multi-decade lows. The math is simple and brutal. You can only sell what isn't there for so long. Eventually, the mirage evaporates, and all that is left is the hard, cold reality of the metal itself. In the next chapter, we will go inside the vault of a retail dealer to see the dealer's dilemma. The impossible math they face when the paper price they are forced to use as a benchmark has nothing to do with the cost of keeping their lights on. To understand the sudden appearance of the 70% premium, you have to step behind the bulletproof glass of a local coin shop and look at the world through the eyes of the dealer. For the average investor, a premium feels like an arbitrary markup or a moment of opportunistic greed. But in the wake of the great decoupling, that premium has transformed from a profit margin into a survival metric. The dealer's dilemma is a cold mathematical trap that most retail buyers never see until the doors are locked and the out-of-stock signs are taped to the window. It is a situation where the shop owner is caught between a paper price that is functionally fake and a wholesale cost that is ruthlessly real. When you walk into a shop and see silver priced at $50 while your phone says $30, you aren't looking at a dealer trying to get rich. You are looking at a dealer trying to avoid being wiped out of existence by the very next customer who walks through the door. The math of a coin shop is built on the fundamental principle of replacement. This is the concept that most retail investors fail to grasp. If a dealer sells you a 1-ounce Silver Eagle today, their first priority isn't the $5 or $10 they made on the transaction. Their first priority is how they are going to get that 1-ounce Silver Eagle back into their vault so they have something to sell to the person who walks in tomorrow. In a normal market, this is easy. The dealer sells you a coin for $30 when spot is $30, and they immediately call their wholesaler and buy a replacement for $31.50. They keep the $1.50 spread to pay for their rent, their insurance, their staff, and their security. It is a high-volume, low-margin business that relies on a constant, predictable flow of metal. But when the wholesaler's silence began, that flow didn't just drip, it froze solid. Imagine the panic on a Wednesday morning when a dealer logs into their wholesale portal and sees that the cost to restock has completely detached from the spot price. While the Comex screen in the corner of the shop still flickers with a $30 price tag, the wholesaler is now demanding $48 for a single ounce of silver. This is a 60% wholesale premium. At this moment, the dealer faces a terrifying choice. If they continue to sell their existing inventory at a reasonable 10% or 20% premium over spot, say $36 an ounce, they are effectively committing financial suicide. They would be taking your $36, but they would need $48 to buy back the ounce they just sold you. Every sale would result in a $12 loss in real terms. Within a few hours, their vault would be empty, their cash would be insufficient to restock even half of what they sold, and their business would be over. This is why the 70% premium is a defensive wall. The dealer has to price their inventory at a level that stays ahead of their own rising costs. If it costs the dealer 60% over spot just to get silver back from a wholesaler, they have no choice but to charge you 70%. That 10% gap is the only thing keeping the lights on. It covers the shipping, the increased insurance costs of transporting high-value metal in a volatile market, and the massive risk they take by holding inventory that could fluctuate in value while in transit. When you see that $50 price tag, you are seeing the replacement cost in action. The dealer is telling you that the metal in their hand is worth $48 to the person who supplies them, and they need that extra $2 to justify the risk of staying open during a market collapse. Furthermore, the dealer's dilemma is exacerbated by the total disappearance of the secondary market. Usually, a coin shop gets about 30% to 40% of its silver from walk-ins, people selling their old collections or cashing out their investments. This is the cheapest silver a dealer can get. But the moment the premium spiked to 70%, the walk-ins stopped. Nobody wants to sell their silver to a dealer when they see the massive gap between the buy and sell price. Or, more likely, they see the 70% premium and realize that silver is becoming far more valuable than the paper dollars in their wallet, so they decide to hodl and wait for even higher prices. This forces the dealer to rely entirely on the high-priced wholesalers who are already being squeezed by the industrial vacuum we discussed earlier. There is also the time lag risk. When a dealer orders silver from a wholesaler at a 60% premium, it might take 3 weeks for that silver to arrive. During those 3 weeks, the dealer is long on that silver at a very high price. If the paper market finally crashes, or if the premium suddenly collapses, the dealer could be left holding silver they paid $48 for that is now only worth $35. This risk is so high during a decoupling event that many dealers choose to simply stop selling altogether. They would rather keep the metal and wait for the dust to settle than risk selling at the wrong price and going bankrupt. The ones who do stay open are essentially charging you a volatility tax to cover the possibility that the market could move against them before they can finish a single trade. This insider math reveals a brutal truth about the silver market. The spot price is an institutional tool, but the premium is the people's price. The premium represents the true cost of physical possession. When the system breaks, the premium expands to fill the void left by the failing paper currency. The dealer is merely the messenger. They are sitting in a shop, watching their screens tell them one thing, and their bank accounts tell them another. They are receiving frantic phone calls from customers who are angry about the prices, and equally frantic calls from wholesalers who are canceling their orders. It is a high-stress, low-information environment where a single mathematical error can end a 40-year-old family business. Ultimately, the dealer's dilemma serves as the final barrier between the public and the remaining physical silver supply. It is the market's way of saying that the era of cheap retail access is over. If you want the metal, you have to pay the replacement cost. which includes the cost of outbidding a solar company and the cost of insuring a dealer against a systemic meltdown. The 70% premium isn't an obstacle to the market. It is the market. It is the only price at which the physical metal will actually move from one hand to another. As we move into the next phase of this investigation, we will look at the physical proof that the vaults are indeed empty, proving that the dealer and sphere and their high premiums are backed by the hard reality of a vault drain that is visible from London to New York. To understand why the 70% premium is just the starting gun for a larger market panic, you have to look at the hard forensic evidence sitting inside the world's most secure vaults. In the precious metals world, there is a saying that volume precedes price. But in the great decoupling of 2026, it is the absence of volume that is dictating the new reality. While the paper price on the Comex has been struggling to reconcile with the physical truth, the inventory data from London and New York is screaming. This is the vault drain, a systematic and relentless emptying of the world's silver reserves that has moved from a slow leak to a catastrophic burst. If you want to know why a dealer is charging $50 for a $30 coin, you only need to look at the plummeting registered stocks, the silver that is actually available for sale, and realize that the cupboard is not just bare, it is being dismantled. Let's look at the numbers that the mainstream financial media is ignoring. On the Comex in New York, silver is divided into two categories: eligible, which is metal sitting in a warehouse that someone else owns, and registered, which is the metal specifically designated to fulfill futures contracts. Since 2020, registered silver inventories have collapsed by nearly 70%. As we sit here in January 2026, the amount of silver available for delivery has hit levels so low that they are statistically insignificant compared to the open interest, the number of paper promises held by traders. In London, the heart of the world's physical silver trade, the London Bullion Market Association, LBMA, has reported a similar drain, with vault holdings dropping by 40% in just the last few years. This isn't just a tight market. This is a market that has effectively run out of free-float metal. The physical proof is undeniable. In the final weeks of 2025, a rare and terrifying signal appeared: backwardation. This occurs when the price for immediate delivery of silver becomes significantly higher than the price for delivery in the future. In a normal market, silver in the future should be more expensive because of storage and insurance costs. But when the vaults are empty, everyone wants their metal now. We saw traders actually chartering cargo planes to fly 1,000-ounce bars from New York to London just to satisfy emergency delivery demands. This kind of panic logistics only happens when the systemic inventory has failed. When you see a 70% premium at your local shop, you're seeing a localized version of this global scramble. The metal is simply not where it's supposed to be, and those who have it are refusing to let go. What makes the 2026 vault drain different from any previous silver squeeze is the finality of the destination. In the past, silver would move from a bank vault to an investor's safe, and if the price got high enough, that investor would eventually sell it back. But today, the silver is being siphoned into the industrial machine. Once an ounce of silver is converted into conductive paste for a solar panel or integrated into the circuitry of a high-end electric vehicle, it is gone. It is not coming back to the market at $50, $100, or even $500 an ounce. The industrial giants, facing their own force majeure events as Chinese export restrictions hit, have stopped trusting the paper markets entirely. They are now taking direct delivery of every ounce they can find, effectively bypassing the retail and investment channels. This has created a delivery bottleneck that is about to hit the March 2026 futures contracts like a freight train. On paper, there are hundreds of millions of ounces of silver promised for delivery in March. In reality, there is only a tiny fraction of that available in the registered category. When those contracts come due, the owners of that paper won't want a cash settlement. They will want the bars. And when the Comex is forced to admit that the bars don't exist, the 70% premium you see today will look like a bargain. The scramble has already moved past the retail investor and into the institutional level. Central banks and sovereign entities are beginning to look at silver not just as a commodity, but as a strategic critical mineral, similar to how they view uranium or rare earth elements. The evidence of the drain is also visible in the premiums over Shanghai. For months leading up to the January 1st pivot, physical silver in China was trading at a $10 to $15 premium over Western paper prices. This was the market's way of arbitraging the metal out of Western vaults and into the East. The silver was physically leaving the LBMA and the Comex, headed toward the only place that was willing to pay a true price for it. By the time the West woke up to this reality, the vaults were already hollowed out. The scramble is now a fight for what remains. The 70% hike you are facing at the coin shop is the market's way of equalizing with the global floor, established in the East. Ultimately, The vault drain proves that we have reached the end of the paper era for silver. You cannot print silver, and you cannot fulfill an industrial contract with a digital claim. The plummeting inventories in New York and London are the physical receipts of a 5-year deficit that has finally reached its breaking point. For the prudent accumulator, the lesson is clear. The metal is moving into strong hands that have no intention of selling. Whether it's a solar manufacturer in Arizona or a sovereign vault in Beijing, the physical silver is being locked away. The scramble is no longer about who can get the best price. It's about who can get the metal at all. The 70% premium is just the entry fee for a game where the number of players is increasing while the number of chairs has just been cut by 2/3. As the physical proof continues to mount, the narrative of plenty is collapsing. Every day that the vaults remain empty, the pressure on the remaining supply grows exponentially. We are witnessing a historic repricing of a strategic asset in real time. In the next chapter, we will look at the final piece of the puzzle, the new reality for the investor. We will explore how to navigate a market where the old rules are dead, and why owning physical metal, even at a 70% premium, might be the only way to survive the STARS final decoupling. In this new reality, the old mantra of unobtanium, spot plus $2, is not just dead. It has become a historical relic, a memory of a market that no longer exists. For the prudent accumulator, navigating the silver market today requires a total psychological reset. You are no longer shopping for a commodity. You are competing for a finite strategic asset that is being systematically removed from the reach of the general public. On the morning the premium hits 70%, the rules of engagement changed forever. To survive this transition, you have to stop thinking like a consumer and start thinking like a sovereign holder who understands that $50 silver is actually cheap in a world where the supply is effectively zero. The first strategy for navigating this landscape is the death of market timing. In the old world, you could wait for a dip in the paper price to save 50 cents an ounce. In the new reality, waiting for a $2 dip on a screen can cost you 20 weeks in a delivery queue. We are moving into a volume over price phase. The most successful accumulators right now are those who have abandoned the paper charts entirely and transitioned to a strategy of ailing allotment. This means, instead of waiting for the perfect price, they are securing whatever physical metal becomes available the moment it hits the dealer's inventory, regardless of the premium. They understand that a 70% premium is a high entry fee, but it is infinitely better than a 0% chance of ownership. When the industrial vacuum finishes its work, the premium won't just be high, the availability will be non-existent. One of the most effective ways to acquire silver in this high premium environment is look where the solar siphon is not looking. But why would anyone pay $50 or $60 an ounce when the news says it's $30? This is the core of the new reality, the scarcity math. If you are a manufacturer who needs silver to keep a billion-dollar factory running, $50 silver is a bargain compared to a $0 revenue stream. For the individual investor, the math is similar. If you believe the dollar is being debased and the global supply chain for hard assets is breaking, then silver is no longer in our investment. You hope goes up, it is insurance. You hope you have. In a scenario where the physical market completely breaks away from the paper market, the spot price will stay at $30 because the banks will keep trading digital air, but the street price will move to $100, $200, or beyond. At that point, the person who paid $50 today will be seen as a genius, while the person who waited for 28 will be holding nothing but a digital screen and a sense of regret. We are also seeing the rise of the direct-to-refiner movement. Sophisticated accumulators are bypassing retail shops and seeking out small independent refiners who still have access to secondary market scrap. This requires more effort, more networking, and often larger minimum purchases, but it is one of the few ways to circumvent the wall of premiums that the major wholesalers have erected. It is a return to a more primitive, inside-the-vault style of trading. You have to be part of the network to get the metal. The new reality is that silver has become a private market once again, just as it was for most of human history. The window where you could buy it with a click of a mouse at a transparent price was a historical anomaly that has now closed. Furthermore, we must address the zero supply scenario. Many analysts dismiss the idea that silver could simply run out. They argue that higher prices will always bring out more supply, but they are forgetting the industrial priority. If the Chinese government or a Western solar giant decides that silver is a matter of national security, they will not sell their stockpiles back to the market at any price. They will keep it. In that world, physical silver becomes unobtanium. If you can't buy it at $100, then $50 was indeed a gift. This is why the protagonist must shift their mindset from what is it worth in dollars to how many ounces do I have? In the coming months, the weight of your safe will be a more accurate measure of your wealth than the balance of your brokerage account. The final decoupling is the endgame of this process. It is the moment when the Comex declares a force majeure and settles all contracts in cash because they have no metal left to deliver. When that happens, the paper price will become irrelevant. It will be a dead number. The only price that will matter is the one agreed upon by two people standing over a physical bar of silver. The strategies we are discussing today, buying in any form, ignoring the paper charts, and paying the out-of-reality tax of high premiums, are all designed to get you across the finish line before that moment arrives. You have to accept the new reality that the world is no longer producing enough silver to satisfy both the green monster and the private investor. One of them has to go hungry. As we move into the final chapter of this investigation, we will look at what the future holds for the sovereign holder. We will paint a picture of a world where the paper market has collapsed entirely and silver has returned to its throne as the ultimate form of liquid, private wealth. The 70% premium was the first alarm bell of this new era. The question is no longer why the prices are so high, but rather how much longer the buy button will work at all. The transformation of the protagonist is nearly complete. They have moved from a chart watcher to a medal holder, and in doing so, they have secured a seat at a table that is quickly running out of room. The 70% premium spike was never meant to be a temporary anomaly. It was the first crack in a dam that is now completely giving way. As we move into the final phase of this market evolution, we are witnessing the birth of the final decoupling, the moment where the paper market and the physical world don't just drift apart, but permanently sever their connection. In this near-future reality, the flickering numbers on the Comex and the LBMA screens have become nothing more than historical noise, a ghost price that reflects a world of digital promises that can no longer be kept. The infrastructure of the old financial system is being left behind as the trade of silver moves into the shadows, governed solely by the brutal, honest law of physical availability. This is the endgame of the Great Scramble, where the prudent accumulator completes their transformation into a sovereign holder, standing outside a collapsing system with the only asset that still speaks the language of truth. To understand the final decoupling, you have to imagine the day the settlement crisis hits the major exchanges. It begins with a series of quiet, emergency notices sent to institutional traders. The message is short. There is no metal available for delivery, and all outstanding contracts will be settled in cash at the previous day's close. In an instant, the paper silver market is exposed as a massive unfunded liability. The thousands of tons of silver that were supposed to be backing the global financial system are revealed to be missing, diverted months ago into industrial vaults and sovereign reserves. When this news leaks to the public, the paper price of silver might actually crash, as the contracts become worthless slips of paper that no longer offer a path to the metal. But in the real world, on the street and in the private vaults, the price of an ounce of silver enters a vertical climb that no chart can capture. This is the world of the sovereign holder. In this environment, you don't check a website to see what your silver is worth. You look at what it can be traded for. The silver bar becomes a universal key. In a crumbling economy where digital currencies are tracked and paper fiat is losing its breath, physical silver returns to its 5,000-year role as the ultimate form of private, liquid wealth. The person who paid a 70% premium back when silver was only $50 now finds themselves in possession of something that cannot be canceled, frozen, or devalued by a central bank. They have bypassed the gatekeepers of the traditional market. They are no longer a customer of a silver dealer. They are the central bank of their own family. The struggle to acquire silver during the Kawal of premiums was the trial by fire that prepared them for this moment of absolute financial autonomy. The trade of silver in this post-decoupling world shifts from the public exchange to the private vault network. Because the industrial demand from the solar monster has effectively consumed the wholesale supply, the only silver circulating in the economy is the silver held by private individuals. This creates a peer-to-peer market where silver is traded for high-value goods, land, and services. The spot price has been replaced by the availability price. If you have 100 ounces of silver, you have more than just metal. You have strategic leverage. You have the one thing the industrial machine desperately needs but can no longer find. The protagonist of our story, once worried about a few dollars in premiums, now realizes that they are not just holding an investment, they are holding the refined energy of the future. They are the only ones left with the seed corn of the next industrial age. This final stage is characterized by a black market for industrial inputs. We will see scenarios where large corporations, unable to fulfill their orders through official channels, begin to offer buyback incentives to private holders at prices that would have seemed insane only months prior. The 70% premium that started this journey will look like a quaint discount. In the final decoupling, the premium becomes 100%, 500%, or even 1,000% over the dead paper price. The silver market becomes bifurcated. a fake paper market for the masses, and a high-stakes physical market for the sovereigns. The protagonist S journey concludes when they realize they have no intention of selling for dollars at any price. They have achieved the ultimate goal of the prudent accumulator. They have transitioned their wealth out of a system of debt and into a system of substance. The psychological shift in this final chapter is the most profound. For years, the investor was taught to value their wealth in digits on a screen. But as the paper market collapses, those digits lose their power to command the physical world. The sovereign holder looks at their stack of silver and doesn't see dollars. They see security, time, and freedom. They see an asset that has survived the fall of empires and the collapse of every fiat currency in history. The 70% hike was the alarm bell that woke them up, but the final decoupling is the new day. They are no longer at the mercy of the Comex or the big banks. They have taken physical possession of their future, ensuring that while the rest of the world scrambles for a digital mirage, they are standing on a foundation of solid, unshakable metal. As the curtain closes on the eras of cheap silver, we see the final picture clearly. The ghost in the machine has been exorcised. The warehouses are empty, the paper contracts are being burned for cash settlements, and the metal has moved into the hands of those who had the foresight to pay the reality tax. The story of the 70% premium spike wasn't a story about a price jump. It was a story about the end of an illusion. The protagonist has reached their destination. They are no longer a victim of the industrial vacuum or the wholesaler S silence. They are a sovereign holder in a post-shortage world possessing the one thing that will always be in demand, always be scarce, and always be real. The great decoupling is complete, and for those who hold the metal, the real journey is just beginning.